So wonderful afternoon, friends. Hope you're doing fine. I'm going to say a few important questions in your AFM newly added, which was there in your SFM old syllabus. So do check it out to make use of it. First one is balance sheet of Mrs. Sundry Limited as on the request is as follows. Be very careful. The rupees is in lakhs. These are the various mistakes which candidates tend to make. So various details is given. Sales for the year is 6,000 lakhs and sales are expected to be 20% during the year. So profit margin dividend payout is given, and you require to determine the amount of external fund requirement and the amount to be raised for short-term, long-term funds and the issue of new equity. So various data is given. What exactly, what is the key mistake you tend to make is this. You see, if you see the fifth line in your computation, the additional funds required 14,000 minus 2,000, that is your payables and provisions. See the note carefully. As current liabilities shall also be increased proportionately with increase in sales. So you have to subtract that and you have to apply the given percentages. So if you do that, you will be the balance to be required to be from external sources to be raised will be 2,256 lakhs rupees. So and the sales to short-term loans and payables provisions 4:3 ratio of fixed assets to long-term loans is 1.5. Debt equity ratio should not exceed 1.5 as given in the question. So if we do that, the amount to be raised for short-term funds will be nil and amount to be raised for long-term funds will be, so new fixed assets is 6,000 plus 20% of 6,000, that will give you 7,200 lakhs, and the new long-term loans as per the given criteria is 7,200 by 1.5, that will be 4,800. So the amount to be raised will be after 7,200 minus 4,800 minus 4,000, that will give you 800 rupees to be raised. So amount to be raised from external sources is 2,256, less amount to be raised for long term, so long term funds is 800. So balance amount to be raised from new equity will be 1,456 lakhs rupees. So hope all of you have till now. Very nice question, very easy question, scoring question. It marks a lot of chances. So moving on to the next. Compute EVA of X limited with the following information. So various data is given. So the key things in the previous question, the mistake you can make is the 2,000 that you should subtract, remaining straightforward. And in this question, you should give impact to non-cash expenses, that is rupees 30 lakhs. So for arriving no part, that is very important. And then if you proceed with the VAC computation, your economic value added will come to. So the no part will be 460.5 lakhs and your capital charge will be 135.52. So 460.5 minus 135.52 will give 396.28 lakhs. So that will be your economic value added. So another very important question is a proposed foreign investment involves creation of a plant with an annual output of 1 million units. This is your current RTP, very important question. So you are required to find out annual cash flow after tax and the expected value of cash flow after tax, assuming no repatriation profits, and viability of the investment, assuming an initial investment of $25 million on plant and working capital with the required rate of 11% on investment. So see this presentation, this is very important, the various scenarios. This cost point is important, the variables in 0.3 and 0.15, so that will give you 5.7, 5.55. So that will give you in turn, if you apply a profit before tax of 30 lakhs, 34 lakhs in scenario 2 and 36 lakhs in your scenario 3. And then the expected value of cash flow can be using probability factor. Then viability of proposal will be US dollar 4.15 crores. So value of the inflows is 4.5, but your initial outlay is only 2.5. So NPV will be rupees 1.65 crore. So it is positive. So project is viable. So all the three questions are very important. So first one is from study material, second one is from November 24 RTP, and third one is from May 2025 RTP. All the very important questions to make use of it. Best wishes, keep going, all the very best.